Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. There is but one Convexity Maven in the world, a moniker that belongs uniquely to Harley Bassman. A 35-year career in financial markets has left Harley steeped in all things relating to the price and characteristics of optionality. Our discussion on this episode of the Alpha Exchange starts with the early days of his career, including a position in Treasury option markets in the early 1980s. Juxtapose that experience when rates and inflation were sky high with his more recent market presence when rates and rate vol have rarely been lower, and one can appreciate the breadth of experience Harley has had. Our conversation covers the term structure of rate volatility, the variance risk premium, and the way in which option sellers convert potential future capital gains to present-day income. Along the way, we discuss the Move Index, a well-followed metric for bond option volatility that Harley himself designed, as he explains how the move is tied to the slope of the yield curve. Lastly, Harley shares his views on global disinflation and what central banks are up against. Please enjoy this episode of the Alpha Exchange, my discussion with Harley Bassman. Harley, it's great to have you in New York today, and thanks for stopping by.
Thank you.
We have plenty of ground to cover here today, and you're coming by at a time when your Move Index has been very, very topical. There's been this big surge in interest rate volatility. So let's start from the beginning. You got started in your career in the early 80s, and you very, very quickly jumped into the derivatives markets. Tell us a little bit about your early part of your career.
Well, I'm from California, so I have a suntan and a smile. I went to school in San Diego, went to Chicago for business school. That was when you were able to go right from college to business school, which you can't do anymore. And I ended up on Wall Street in 1983 at Drexel, where I worked on Treasury options, started their business there. 85, I was at Merrill Lynch, and I was there for 26 years. Did options, mortgage derivatives, all the fun stuff.
You were really responsible at a very early point in the derivatives markets for some pretty interesting product creation. You were very involved in some of the early products on the mortgage side. What were some of the initiatives that you were a part of or responsible for that you felt especially were impactful in terms of the development of the market as it has come to be?
The Move Index, clearly, I'm quite proud of. That was, I won't call it an accident per se, but the idea was that there really, at the time, was not a metric to go and help people understand volatility. I'll use the word as an asset class, but I'm not sure I agree with that concept, frankly. But a number that people, the other traders, the salespeople, clients can look at and say, okay, this is a number for volatility, and it was higher or lower than where it was last month, last year, 2 years ago. What's the average been? Very similar to the VIX, a point-and-click number where you could use as a reference, because there's so many ways to measure volatility, so many different places where you can take vol from 1 month options, 1 year options, options on the 2 year, options on the 30 year. It was a way to simplify it down to a single number and then have a long history to it.
So the Vix Index, founded in 1993, Bob Whaley, at first was targeting he had 8 different strikes in there. He had puts and calls, one out of the money from the top side, one from the downside. And he had 2 different months that he was representing. And that was based on S&P, at least initially 100 options, and then it moved to S&P 500 options. If you can talk us through the calcs that go into the inputs into coming up with the Move Index number, what are the feeds that go into the output for the Move Index?
The Move actually is much simpler than that, basically because it was based on an over-the-counter market where we could have a constant 1 month option. The most liquid point in Treasury options at the time was 1 month options, always 1 month. It was very liquid. And we'd take a blend of options on the 2 year, 5 year, 10 year, and 30 year, weighted 20, 20, 40, and 20, double weight on the 10s because that was the most active, most liquid instrument there was. And that was it. Very simple.
One of the things that I always, for the guests that have had long enough tenure in the markets to have traded through and experienced the 1987 stock market crash, one of the things I always think is interesting to review is, of course, this was a seismic, massive one-day event in the S&P 500, but the kind of up crash in bond prices that resulted was also of multi standard deviation event. The Fed coming to the rescue and the sort of gigantic rally in interest rates that occurred as a result of October 19th, 1987 What perspective do you have on the 87 crash? Where were you and what was that like for you?
I indeed was there. As far as the crash goes, I think as I've written about extensively, and you can find them on my website, convexitymaven.com, most of the big market shaking events occur when people, investors, the market positions itself short convexity. And convexity in simple terms is how is the risk balanced? If one has a bet, an investment, an exposure, where for equal movements, you could make $1 or lose $1, that's zero convexity. If you could make 2 and lose 1, positive convexity, lose 3 and make 2, negative convexity. People are not built very well to handle negative convexity. And there are times when people get short optionality explicitly via options or implicitly versus structured product or something else. In 87, you had what was called portfolio insurance. And what that was someone had the bright idea to say, okay, don't buy a put, but instead delta hedge or trade your portfolio as if you were long a put. So that meant as the market went down, you would sell a little, and as it went up, you'd buy a little to replicate the hedging, trading action. When you had the big down move, all these people who had portfolio insurance had to sell, and their action of selling pushed prices down further, which then created more selling. So the portfolio insurance was not the cause of the crash. It was the gasoline on the fire. Other things drove the initial price movement down. You've had similar experiences in 94, in 98, in 06. And I'd say right now we're looking again at building up of a negatively convex profile. And the source of that is going to be found in passive investing. Passive investing, when people are investing as index funds, has a slight negatively convex profile, the way it's structured. And with more and more money going into that, that could be a problem in the future.
Do you think it's negatively convex in the sense that some have argued that passive investing is a momentum strategy? By definition, your portfolio winds up long the winners. You're long Apple, you're long Amazon, because by virtue of market cap weighting in a passive investment strategy, you wind up owning the biggest caps, which are the stocks that have done the best. Is that a form of negative convexity? Or when you talk about is a Delta One product that's negatively convex, how do you think about that?
Really more of how the portfolio seems to perform versus the index. And you've seen the overperformance of passive indexing because it looks and barks like being like a covered call of sorts, not one for one, but a little bit short optionality. And that's why it's given you a little extra juice in its low vol environment, but the wings kind of tip south towards the edges. I wrote about this and others have also that it seems like you have about like a 4 to 5% out of the money put. That's kind of how it looks. And if you look back to what happened a year and change ago when the Vix products blew up, that occurred when you had about a 4.5% drawdown in the market. And I think you still have that kind of concept that kind of drawdown will create selling that could be problematic.
You talked about this concept of negative convexity, optionality. We all know that you should get paid for writing options, and you typically do. And I think the sort of almost existential question is, are you getting paid enough consistently? And there's some investors that would never sell an option. There are some investors that would never buy an option. I guess this is what makes a market. Over time, and I'm speaking specifically to equity risk, there is a vol risk premium that we observe pretty consistently in equity options, right? The VIX clears realized vol at a premium. When you look at the long history of rate volatility, is owning rate volatility a good deal, a fair deal? Like, how would you characterize the experience of owning optionality over time in rate volatility?
Your proposition is correct that for the liquid instruments, so equity, rate, FX, you will tend to see implied volatility trade about 8 to 12% over realized volatility over time. And that is a fine strategy to engage in where you sell this optionality and collect the alpha excess risk premium. The key thing is you have to size it properly because it's a type of insurance game, which means you're going to be picking up pennies and you'll lose dollars. The dollars you're going to lose will not be that often, but when you do, it's going to be a big number. And like any insurance company, you have to be able to go and be structured in a way where you can survive the earthquake or the flood or whatever it might be where you have to pay out on the risk. So nothing wrong with that. And the reason why you have that excess premium is because people are not risk neutral. People are risk averse. Losing $1 hurts more than the pleasure of making $1. And that's why you have this risk premium there. So I have no problem with selling options if you size it properly.
If you were to characterize just kind of step back for our listeners, the supply and demand of optionality in rates, who's on the left side of the ledger? Who are the vol sellers? And then that vol selling is satisfying what demand for optionality? How would you characterize the kind of two sides of the ledger?
I think in simplistic terms, you could go down describing options down the classroom Greeks, crazy numbers, or you could look at it more heuristically. Option trading in its grand form is about the transformation of potential capital gains into income. So if you own a stock, IBM at 100, I'm making this up completely, and you sell the 105 call for 3 points. What you've done is you've said, I'll have a 5% gain, I'll take in 3 more points up front. So I've taken income like a dividend, but I've given up any of the big gains if it goes to 110, 120, 130. There's nothing wrong with that strategy of being more risk averse and preferring to have income, for sure income, because you take the premium in up front, versus potential of the big win. The people that buy it, they're willing to forsake income for the longer term capital gain. And at a fair price, that's a fine transformation between two people who have different portfolio goals. And that works fine. You tend to see people being better sellers of options in general because people like the idea of income in their pocket versus the uncertainty, the idea of a bird in hand. The buyers tend to be, because you're spending money, which people don't like to do inherently, people who have a risk they need to cover. Usually it's a regulatory issue, although there are some speculators who will do it also. Tail hedges are a different animal entirely, and so we can kind of leave that alone.
In terms of the entities that are maybe more natural suppliers of optionality to the market, is there a classification of entity that tends to write options more versus buy them?
Oh, you have plenty of income funds, income ETFs that go and basically do covered call strategies of some sort. They're all legit investment ventures as long as you understand what you're getting into.
When you look at just rate vol over the years, and this is just me, the person that follows interest rate markets, interest rate volatility, but is not engrossed in them on a day-to-day basis, what we often hear is the sort of presence of the GSEs and the impact that they've had over periods of time in terms of trading volatility. Give us a sense as to their impact as it kind of maybe peaked into the financial crisis and then post the crisis. What's the market clearing price of interest rate volatility in a world where the GSEs are not what they once were?
Well, I mean, the GSEs, they ran two businesses. There was the mortgage guarantee business, where they basically wrapped bonds, issued Fannie Mae and Freddie Mac securities. And there was the retained investment portfolio, I'll call it a government guaranteed hedge fund business that they were running. In that business, that's where they were buying options to hedge out their portfolio. That business is now basically gone. So their demand for optionality has been reduced dramatically. But for a great period of time in the late 90s and the early aughts, they were the biggest buyers of options. So that's one reason why vols have come down, especially in the 1 year to 3 year sector, which is where they did most of their hedging.
There's a very, very often repeated almost narrative in the market that speaks to the impact of the central banks on volatility broadly across asset classes, but perhaps most specifically in interest rate markets. I was hoping you could comment on that. I was looking at, there's a JGB Vix that someone's publishing. It's at about 1 and change, been at 1 and change for a long period of time. Euro swaption vol is close to that, higher, but very low. How would you speak to the impact of central banks, maybe via things like forward guidance or extraordinary policy? What are the central banks doing to interest rate volatility?
There are 2 or 3 drivers to why volatility is low right now. Number one, central banks reducing volatility is a feature, not a bug. That was the goal of central banks. They wanted to create inflation and they wanted to create investment activity. And by buying safe, secure assets, treasuries, swaps, futures, mortgages, taking the rate down on them, they force people into investing money in credit or stocks or other types of activities. And they did that by reducing volatility and reducing the risk. So that was a goal of central banks. Number two, taking rates down reduces interest rate volatility. You will not see negative rates in the U.S. That's, I won't call it a prediction, I'll call it a fact. They have it in Europe, I understand that, but the population of the U.S. would not tolerate that. So if you have a zero boundary and you take rates down towards zero, you're cutting off a massive proportion of the distribution of where the asset can move. Basically, I'm saying that a bond can only go to zero and stop right there. If you cut off all the possibilities of volatility, or some of them, well, then you chop down the paths and you reduce the risk and the volatility. So that's why you're seeing the move go down right now, is basically this moving towards zero rate. If you see rates go up, you would see the move rise. I would not call the move a crazy number right now relative to its location towards the zero boundary. And then number three, and I would say most important, and if you go to my website, I've written about this extensively, the relationship of the yield curve to implied vol. That's A number one for rate volatility. And by the way, it happens to also map pretty well to credit and the VIX. When you look at the yield curve, so the spread between the 2-year and the 10-year, let's say, if you have a very steep curve, so making up numbers 2% 2-year and a 5% 10-year, you can figure out what the forward rate is from those two numbers. And the steeper the curve, the more distant the forward rate is from the spot curve. If the curve inverts, same thing, you just have a lower forward rate. The more shape there is to the yield curve, the bigger the distance between the forward rate and the spot rate. And since time can't go backwards, only forward, we know that the forward will become today's spot rate, and therefore you have to have market movement. Either the forward goes to the spot or spot goes to the forward. There's an uncertainty, but it's a scalar of a distance to move. In a very flat curve, so 2s are at 4 and 10s are at 4, well, the forward's 4%, and therefore there's not that much embedded risk in the system. To the extent that you have spread between the spot and the forward, vol has to rise because you have more uncertainty, and implied volatility is just the cost of risk. And if you look at the charts, you will see that implied vols move almost synchronously with the yield curve. And by the way, so does credit, and so does the VIX. They all tend to move in the same direction. That should not be a surprise at all. If you had a super mega hedge fund investment vehicle that was moving money around between the best opportunities, you would see that as the curve flattens, so there's not much value in duration trading, it'll move to credit. As that tightens, it'll move to equities, and it'll keep all moving around. So that's the big idea. So I don't think vol is the wrong price right now, given a dead flat curve and near zero boundary.
That's an incredibly good and valuable explanation that ties the shape of the curve with implied volatility. Let's run with the curve itself for a little bit. And I wanted to also circle back because I have certain observations on the shape of the vol curve in equities that I'd love to get your thoughts on as it relates to things like rates. But the curve itself, lots of conversation around its signals. It's been successful in predicting recessions, maybe a couple of false positives, not as good about predicting future equity performance. But now we've got certain curve inversions. How do you look at them, or how should investors be looking at the curve these days? Is it the same as 10 years ago? Does it matter as much, or is it a different animal?
As I'm fond of saying, it's never different this time. It makes good press to go and say it's different and explain why. And the circumstances overall, they do seem a little different, but people's investment careers aren't quite long enough to encompass the cycles that happen over and over again. I won't delve into my thoughts about the current president, but just say this is not the worst ever. In the 60s, we had students being shot in the street. We had 2 assassinations. We're not there yet, okay? So this is not the worst it's ever been. And we've had problems in 06. We had our problems in 98, 87. It's never different this time. It's just, the way the game plays out is a little different. What I will say that is always the same is that convexity is always lurking near the scene of the crime. And because it takes things like that to, when markets start moving, you don't have stability to go and counteract. So that's a big thought there. As far as the curve goes, to get the yield curve to invert, you could say there's QE or other various forces driving it. At the end of the day, people are buying long-dated securities under the risk-free rate. My favorite chart right now is the 5-year rate. So the 5-year rate, 5 years from now, is under Fed funds. So in theory, that means that people are buying 5-year treasuries for 2024 at a rate under today's Fed funds rate. To do that, you got to be pretty confident there's a problem in the world, or you have asset liability issues that make it so you can't wait around to find out what happens. That is a market signal that something is amiss. What it is, I don't know. And people keep asking what the surprise will be. It's a preposterous question. If you knew what it was, it wouldn't be a surprise. And I'm not going to tell you I know. I just know that there's something destabilizing in the market. And usually you get 18 months from the inversion to the activity. First inversion was in December, so I look for some kind of activity to be revealed for second quarter of 2020.
So 2018, the Q4 was quite ugly for risk assets. How close do you put Powell to the scene of the crime in terms of the damage done to risk assets in Q4?
I don't. I think he's doing a fine job. Should he have done the last hike? Maybe. Should he be cutting rates soon? Maybe. I think that to some degree, it would be helpful to society if the Fed, to some degree, backed themselves out of where they are right now. It's very important for a capitalist financial society to get proper signals about what the cost of risk is, and then look at those signals and make decisions going forward. To the extent that those numbers are manipulated or pressured by the government too much, people cannot make rational decisions. I would place the 06, 07, 08 crisis, I won't say it's the Fed's fault, but the fact that they raised rates at, quote, a measured pace, where they said we're taking rates up by 25 basis points every meeting for the next 2 years, that was dangerous. It was dangerous because people knew what was going to happen, and they could basically make levered transactions against it. This is classic moral hazard. The Fed wasn't looking to cause trouble. That wasn't their intent, but that's kind of what happened. So yeah, they contributed in a great way with that. I think that I understand moral suasion. I understand the Fed's transparency, but I'd also say that to the extent that they offer too much, people will go and use that information to become over-levered or take risks they shouldn't, or take more risk than they should. And that is bad. I think people should be a little skeptical of things, and therefore they invest responsibly and accordingly. That doesn't mean taking no risk. It means taking reasonable, rational risks within the realms of your business or your personal portfolio.
When you look back, you mentioned the financial crisis or the period leading into it, and the Fed being very transparent in terms of its incremental tightening. At least on a couple of measures, things all looked okay in 06, 07. Unemployment was 5-ish%. People are gainfully employed. Inflation was within target. At least in terms of the standard measures of some of the economic statistics that we care about, things felt fine. Of course, there was this just gigantic leverage bubble building up in housing and within the broker-dealer community. And so when we look back on it, I think part of it is just to say, wow, that was almost very obvious to see. Morgan Stanley CDS trading at 22 basis points in early 07 seems now like an incredibly obvious thing that you were supposed to own, and yet obviously a lot of people didn't. So what do we learn from that hindsight to be able to sort of see it as obvious now versus then? And then as you look at the world now, are there things in 5 years that we'll look back on and go, gosh, that might have been something that was staring us in the face? Are there any of those imbalances that you worry about these days?
People in the mortgage market knew there was a bubble in 04, 05. We did not know how it was going to end or how it would resolve itself. I will tell you, I didn't see it coming. I'd like to say I did, but I didn't. Although you knew that there was a problem there. Subprime actually was a public policy good in the beginning. So Fannie and Freddie would make a loan to a consumer at 720 or better, 720 FICO or better. That's called a prime loan. If you were 719, you were subprime. So you weren't a bad guy, you just were a notch below. The original subprime market that I was involved in was making loans to people who were 680 to 719. That's a fine market. People are in good shape. Maybe they're salesmen and they have an income where they make $5,000 in one month and $30,000 a different month, or they have other kinds of activities that are not your standard W-2 income. And making a loan available to these people who were a good credit was a good public policy goal. When we started making loans to people at 520 FICOs, that's a different story entirely. That was problematic. And like most things in the world, a good idea, you could have too much of it and you're sorry. The financial crisis, there's lots of people to go point fingers at, and there's not one villain. What I will say is that to have a game, you need rules. And to that extent, I think Dodd-Frank has been a good thing. Has it gone too far, been more restrictive than it should be? Yes. But once you took down, if you want to look to ground zero of the financial crisis, you should probably look for where they took down the Glass-Steagall rules. That's probably where it all began. I think if we'd had Glass-Steagall still in effect, you would not have had the potential crisis.
We were talking earlier about convexity as sort of being sometimes an amplifier of some risk off. I was very close to that Vix event. That's an area of focus for me. And you saw this product building up, and you can just do some relatively straightforward math to see that if the Vix went from here to here, the result was going to be this forced unwind in a very, very instantaneous period of time through the Vix complex. What's the stance of convexity now in markets that you think matter? Are there leveraged players that are short volatility and earning the carry? Is it something that you think is a potential source of imbalance at this point? Or is it, there'll always be people that are short volatility, but not this particular period of time is not really a worry?
I think the listed option market, the swaption market, those basically explicit options, those are fine. You have buyers, you have sellers. They usually go through some kind of clearing agency that demands margin to be held. That's not your problem. The problem is going to be the implicit convexity of embedded in structured notes or other investment vehicles where the owner did not expect to be in a position where the portfolio can be as troubling, more troubling than they might expect. The drawdown will be bigger than they expect, and that then causes alarm bells and forces them to take actions they didn't plan on taking. Convexity is a difficult risk for people to manage. For many people, it's not intuitive, and if it's unexpected, that's where your risk is going to be. That'd be my concern, is how do you go and should be know your client rules to make sure people get into the right products.
We touched a little bit on the rate volatility curve, or maybe the surface of rate volatility. And the VIX curve or surface is one typically got a fair amount of put skew. The downside put costs more than Black-Scholes would tell you it's supposed to. You got the skew. And then you have the term structure too, which also can be challenging. You were talking about the rate term structure. So the vol term structure in equities is pretty upward sloping. It makes carrying options especially hard because you get theta decay, but also this roll down. The rate vol curve I understand to be pretty different than that there are parts that you don't absorb that same roll down. Can you kind of bring that to life in terms of the kind of surface of interest rate implied vol?
I mean, the term surface for any option category, so rate, equity, commodity, foreign exchange, it has to do with the basic supply-demand features going on. In the equity market, you have option sellers in the front end, so 1 to 3 months, and then you can have buyers more in probably the 1 to 2 year sector. Those buyers are going to be usually insurance companies offsetting risk of the products they've sold. But from a grander standpoint, the average VIX is probably 1920, somewhere in there. It's a little lower than it was prior, may have been 21. Average realized is going to be 16, 17. So there's your 10% premium, called 16 realized and 19 implied. If you get the VIX up above, let's say, 25, you're going to see a downward sloping term surface, because what tends to happen is markets try to figure out, will price themselves so that the forward goes towards the long-term average. So you're always going to see, often see the VIX term surface point towards 20-ish. So if you get, to get 1 year options to 25, you'd need the VIX at probably 35 or 40. So the forward is 20. Rate options are a little different because the supply demand is different. The short-dated options are a balanced market. You used to see a huge hump in the 1 to 3 year sector, and that's because that's where Fannie and Freddie were buying options. That's kind of gone now, so that's flattened out. The very back end, so 5 year on out options, tends to trade at a lower vol, and that's because of structured note issuance, primarily out of Asia. So you have to go look to see where those are. This is very similar to what you could look at in Europe. Their option service is very different because they have a much larger structured note market in European equities than in the US. And the reason for that is that in Europe, you have an older, more stable, more income demanding demographic, and they prefer to own their equities indirectly via structured notes where they sell off the upside and increase the coupon, which creates some very interesting option opportunities for people who have the ability to go trade long-day derivatives.
Yeah, and the structured note business is, of course, exists in the U.S., but it's really a Europe and Asia phenomenon, at least in the equity products, that these products are huge. And especially in Europe, the sort of Greek profile that the dealers seem to assume is one that when spot goes down, the dealers actually get longer vol. It's an interesting, almost third-order Greek, where you'd think the reaction function would be to accelerate an increase in volatility because spot's falling and there's short volatility. They're actually getting longer volatility as spot falls. Now, it doesn't mean that vol can't go up because asset prices fall, vol tends to go up. But the dealer books, again, at least in Asia, are tending to get longer. So a lot of these skews versus the U.S. are demonstrably flatter.
Indeed. They get longer vol the first 10 to 15% down. After that,
all bets are off.
It flips the other way.
Right.
So yes, but generally the European markets are almost reversed in the U.S. in the longer dated skews.
And what about for rates? What is the dealer profile of exposure to Greeks? What happens? What does that look like as rates rise or rates fall? Is there a specific conclusion, or it really all depends?
Where there's significant dealer risk profile impacts, it's in long-dated options that really civilized people don't trade in those markets. It's purely institutional. In the short-dated option market, call it 6 months on in, right now you're seeing out-of-the-money calls. So options for lower interest rates are actually trading above the puts, which is very strange, but it kind of makes sense. If you think about it, I'll make up numbers. If the 10-year is at 4% and vol is X, should an option at 6% or 2% trade to a higher skew? Traditionally, and we're talking basically pre-financial crisis, the put would be much higher than the call because people are inherently long assets. They're long governments, or long mortgages, long corporates, they're long interest rate risk, and usually they want to buy a hedge for their exposure. What happened after the financial crisis is people recognized that if we got the 10-year to 2%, that would probably be a bad thing as far as risk goes. If we get to 2%, there's probably some grand problem in the world. Whereas at 6%, you probably have growth, you have profitability, you have stability. Actually, a 6% world is probably a happier, nicer place than a 2% world. And what you've seen is the skews reversed now, which very early on was kind of a bothersome to people. People are used to it now, but I remember in the early aughts when you first saw the skews flip that people were kind of wigged out, and there were some quite large Wall Street losses portfolios that had this trade on the wrong way.
Just running with Europe a little bit. And you made a reference earlier just about price discovery, and that the central bank, the heavy hand of the central bank and being more active in markets might be inhibiting some of that price discovery. Certainly when you set policy rates at minus 40 basis points, that seems like a heavy hand. I don't know if that's the right level or not. It's just a strange level. But even out 10 years, Germany now got down to minus 20 nominally. I guess it's influenced by the policy rate if you start at minus 40, but that's a long way out. What are your thoughts on, let's say, just Germany trading at minus 20 basis points nominally? They have positive growth. I know the economy is slowing. Their break-even inflation is 90 basis points positive. So that term premium is incredibly negative. What are your thoughts on that price?
Negative rates for the front end, so 3 months on in, is not anomalous. We've had this before. Whenever you have real crisis, you want to have your cash somewhere safe. You can't put it in your mattress. You can't bury it in the ground. So paying an insurance premium to have your assets safe and easily accessible, that's fine. Longer rates at negative is kind of preposterous, but I mean, they exist. I think all these things keep pointing back to we're asking the wrong question. Negative rates, low rates are not the problem. They're a symptom. We have to look at what the bigger cause is, and the cause here is demographics. Post-World War II, the baby boom generation is getting older, and Europe is a little ahead of us, and Japan is a little ahead of them. And the demographic, as you start to retire, is you want to sell equity and buy debt. You want to go and buy interest-bearing instruments so you can buy food. And this demographic is the pig in the python flowing through Japan and Europe and possibly in the U.S. Not to talk politics too much, but If you want to get worried, look at immigration policy. In the U.S., we have a lower birth rate than we used to have, but we still have immigration, legal or otherwise, I don't care. People coming in and they're working. You're maintaining a ratio of workers to retirees that's somewhat rational. To the extent that the U.S. really cuts off immigration, labor force growth rate, that's a problem, man. That would be my biggest worry, talking macro policy. More than tariffs or anything else, is reducing labor force growth rate. At the macro level, at 30,000 feet, the economy is very simple. Number of people times hours worked times productivity. And what you saw happening in the 70s and 80s was a massive group of people coming into the market, the boomers, becoming more productive. And then we followed that with women coming into the market that weren't there before, more growth in the 90s. This is not magic. It's just very slow moving and a hard thing to trade. I have said in the past, and I'll repeat, we will not see the U.S. Treasury 10-year above 3.5% until at least 2023, because you got to go wait until the demographic turns back up and the boomers have basically moved into retirement and the millennials are entering the workforce, forming families, and then doing what families do. They have kids, they buy cars, they buy houses, they buy washing machines, and that whole thing. The inflation rate of the 70s and 80s was no magic. It was just the pure demographic, the baby boomers becoming age 30, 35, 40, having lots of kids, and buying capital assets. That's it.
Yeah, if you look at some of those long charts on things like labor force participation versus yields, there's over a long period of time, there's correlation there. And sounds to me that you have some sympathy for the secular stagnation sort of framework, which is to me a very long-term sort of demographically motivated explanation for the clearing price of interest rates, that we should maybe expect rates to stay low for a lengthy period of time. And maybe that while the central banks are very active, maybe they've been following markets rather than leading markets. We would have wound up here anyway. Are you sympathetic to sort of the notion that the central banks have not pulled interest rates this way, but that they've sort of followed this long-term pathway down in the market clearing price of interest rates, which just represents savings versus investment and the sort of mismatch?
Agreed. I won't say that it's a permanent condition. The demographics of this country change significantly 5 to 10 years from now. And I think that assuming we have ordinary immigration policies in the U.S., you will see rates rise, I'm not sure significantly, but they will rise enough to notice 10 years from now.
There is more and more conversation about the role of the Fed. It seems like there's more and more pushback from the president and from, I think, even the folks that are going to be running against Trump in 2020, that the Democrats want, I think, to take the reins a little bit away from the central banks. It seems like it's happening maybe in some other countries as well. There's talk about things like MMT and just running larger and larger deficits. So I wanted to get your opinion on the notion of bond market vigilantes. From the early days, people say it was Ed Yardeni, I think, that might have coined the phrase. I'm not sure about that. But Carville had his commentary in the early 90s about, I want to come back as the bond market because you get to push people around. And my question to you, Harley, is the bond market doesn't seem to be pushing anybody around. The central banks do what they want. The governments are running trillion-dollar deficits. The U.S. is amidst the 3.5% unemployment rate. It's peacetime. It's prosperity, at least from a top-line standpoint. And yet inflation expectations are falling low. Central banks around the world are behind their target of inflation, and they're running massive deficits. Where's the bond market vigilante? What happened?
They're just following inflation and the supply demand for capital. They're still there, but the circumstances have changed. Famous expression, when the facts change, I change my mind. What do you do? I think central banks are acting reasonably, rationally within the confines of what they have. In the U.S., there should have been greater fiscal policy in 09, 10, 11. The Fed did their job. Initial rate cuts, QE1. Do I like the idea of bailing out the banks? Not particularly, but there really was no plan B because they were the plumbing of the system, and you can't pull the plumbing out of a financial economy. QE2 and 3, not so much. There should have been fiscal policy instead. The government would not do that. So the Fed had to step in and do that job. Fiscal policy would have been a better means to the same end. Trump is not the problem. Trump is a symptom. The symptom is there's not been wage growth for the vast majority of the country. People who earn a W-2 paycheck have not seen their wages rise that much. The goal of the Fed was to create inflation. The thought was to create inflation in wages by their activities. We did get inflation. It just wasn't in wages. It was in assets. It was in gold, art, commodities, stocks, bonds. Everything went up. The problem is that the people who own assets tend to actually be in the 1% and not the middle of the country. So it wasn't a bad idea per se. It was a good intention. It just didn't work out that way. And when you have, as this policy is played out and the inflation's occurred in capital assets, you've seen income disparity, which is not good. That's the result we have right now. How do you fix that? Unclear. MMT, it's coming, man. If the Democrats win, it'll happen in 2020. Republicans win, it'll happen in 2029. That will be when the baby boomers are all in full retirement mode and Social Security and Medicare really explode, and the government needs to find some way to go and fund it. So it's coming. Is it a good idea? They're not dead wrong when they say that if you borrow in your own currency, that you can't go bankrupt. They're right about that. Japan's a fine example. They're not wrong about using money for fiscal policy as long as there are spare resources in the economy. That's not wrong either. The idea that we'll stop doing MMT once we see inflation, which means the resources have been now fully utilized, that's preposterous because politicians will not turn the spigot off. I've never done that. But I do think that in the grand scheme of the world, it's a bad idea. You cannot print the coin of the realm, sticks, rocks, shiny coins, whatever it might be. You can't print that at a rate faster than the growth of the overall economy without inflation. And this might take 50 years for it to occur, but that will happen. There's no free lunch. And it is possible for politicians, central banks, to create inflation if you try hard enough. Japan finally tried hard enough, and their currency depreciated 50% in a year. So you can do it. The U.S., we could get 8% inflation, but that'd be bad. Question is, how do you get 3% inflation? That's a lot harder to do. Tends to be required to push hard enough, but if you push too hard, so the Fed's trying. MMT is a short-term fine idea, long-term a disaster, and will I be here to see how it plays out? Probably not, but I see it coming because I just don't see a plan B that our current politicians can tolerate.
So let's maybe finish off with some discussion on tails and tail risk, and we were talking about inflation. One of the things that comes from this year after year of inflation shortfall is that the price of speculating that inflation will rise gets crushed. So inflation options, not the most liquid asset class in the world, but you can buy a quote unquote call on inflation for one of the lowest levels in a long period of time, and probably rightfully so. Is that something that if you got a 10-year horizon, let's say, and you're sort of thinking about your overall portfolio, you got your risk assets and the tail of risk assets falling quickly, but also the tail of the nominal value of risk assets or the real value of risk assets getting eroded by inflation. Is that something that should be in the portfolio over a long period of time?
Well, I'm not a fan of any product that is based upon CPI. Not that I'm a Luddite or paranoid, although I do think the matrix is a truth. CPI is somewhat manufactured by the government. It was rejiggered in the late 90s. The government bases a lot of their income programs based upon CPI. Therefore, they have a vested interest in keeping it turned down. Hedonics, I don't believe in. There has been inflation. CPI may have been 1.5%. We've had plenty of inflation in society in various things. So finding a product based upon CPI, I don't like. I prefer to do other investments. If you're worried about inflation and you believe in demographics, you believe that monetary policy can be problematic, this is not a retail trade, but long-dated options. So in my PA, I will sell 1, 2, 3-year options on 20-year rates struck at 4% because I think rates can't get up there, as I said, for the next 5 years. But I also own very long-dated options. I own a 10-year option on these long-dated rates. Vols are crazy low in that sector, and if things go haywire, I'm protected against a seismic shift, systematic shift in rates in the U.S. Against that, by owning that big, long-term 10-year protection, I can be a little more aggressive in the asset side. So I can own levered REITs, closed-end funds, MLPs, things that kick off coupons of, 8, 9, 10%. That will only really be damaged if you get 10, 20-year rates back up above 4. So that's how I've been structuring myself. Tail risk, most tail risk options, specifically in equities, they're not cheap. They are very expensive. I really don't think that people who buy tail risk protection actually ever win, because when things do hit and those options become valuable, people don't cash them in. They kind of wait and then they go back down in price again. So it's really difficult to manage those things. I think tail risk trades work well politically for people who want to say, I have coverage. And if you do get, a huge flub where if stocks are down 20% overnight, they work. If they grind down, they kind of don't. So I'll go back to the beginning over here. If you want hedge protection, sizing is more important than entry level. You are not going to buy the bottom or sell the top. You pick the asset class or portfolio structure you like. You size it large enough so you can make some money that will be impactful, but small enough so if you're wrong, it won't wipe you out. And then you diversify amongst those. I think that's a much more efficient strategy than buying tail hedges that really are not going to work.
Well, I could sit here all day and just pick your brain on the wealth of knowledge that you have across these different asset classes, but we're going to leave it there. And Harley, I really appreciate you stopping by. It was a pleasure to have you on.
Thank you very much.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again.